The tech world is shaking, and as the Magnificent Seven cool off, a massive rotation is underway. Today, we're breaking down the 3 stocks to buy and what you should avoid. Wall Street is shifting capital. While headline tech is selling off, under-the-radar opportunities in the industrial and energy sectors are starting to show their true strength. It's not just a dip, it's a healthy rebalancing. Investors are looking for fundamentals and uniform accounting signals that indicate real growth potential beyond the hype. The Nasdaq has been under significant pressure. This isn't the end of the bull market, but a rotation into layer 3 of the AI revolution, the implementers. Alphabet and Tesla have seen double-digit pullbacks. When valuations get this stretched, even good news can trigger a sell-off as the market looks for a new floor. Look at the CapEx spending. The giants are pouring hundreds of billions into infrastructure. That money has to go somewhere, and that's where our buy list begins. The real winners are the ones building the physical backbone of the AI age. Data centers and industrial hardware are the new frontier for smart money. Even the memory sector, essential for AI, hasn't been immune to the volatility. But within this carnage, we find high-quality names at a massive discount. Micron is a prime example. While the market panicked, the fundamentals stayed strong. This is the kind of uniform accounting play we look for during rotations. Alphabet's massive spending is building a moat. Their earnings estimates continue to climb, yet the price has dipped, creating a classic entry point for long-term holders. This is a global shift. From Asia to the US, the infrastructure for the next decade of AI implementation is being laid down right now by these industrial titans. When you look at the PE ratios, most of tech is still overvalued or expensive. To find value, we have to pivot toward the energy and industrial sectors. AI is more than just software. It's chips, it's cables, and it's massive amounts of electricity. That brings us to our first major buy recommendation. Manufacturing at this level requires immense reliability. The companies enabling this production are insulated from the social media and consumer tech swings. Now let's talk about energy. The market is rotating into sectors that provide the literal power for the data centers we just looked at. While tech is red, these sectors are green. This heat map shows exactly where the money is flowing, away from MSFT and toward the bedrock of the economy. Energy prices and ETFs like XLE are showing massive strength. This isn't a speculative play, it's a fundamental necessity as global demand for power surges. Our first stock to buy is Baker Hughes. They are at the intersection of energy and tech, providing the equipment needed to scale up global power production. The chart doesn't lie. Baker Hughes is seeing consistent momentum because they are an essential partner for every major player in the energy sector right now. Second is EQT. As the largest natural gas producer in the US, they are the primary fuel source for the massive electricity demand coming from AI data centers. Their operational footprint is massive, and they are using AI themselves to drive efficiency. This is a double play on energy demand and operational excellence. These are true exploration and production giants. They have the assets and the cash flow to thrive while tech startups struggle for funding. Beyond gas, we're seeing a resurgence in nuclear and large-scale utilities. The grid is under pressure, and the companies fixing it are in a multi-year bull run. Our third pick is Bloom Energy. Their fuel cells are being deployed directly at data centers, like Oracle's, to provide reliable off-grid power. That is a game changer. Even after a recent pullback, Bloom Energy is bouncing back. It remains one of the most attractive buy-the-dip opportunities in the entire energy space. Their reach is global. With operations from Canada to Vietnam, these companies are diversified against any single regional downturn. They are bedrock stocks. Finally, let's look at connectivity. In a world of remote work and AI, the companies providing the last mile of internet are becoming essential utilities. T-Mobile is winning the 5G race, and their chart reflects that. They are outperforming their peers by providing the infrastructure everyone depends on. Now for the stocks to avoid. First is Netflix. Despite a massive run in the past, the competition is fierce, and the valuations are no longer justified by current growth. Streaming has become a commodity. With so many players, Netflix's ability to drive price increases is hitting a wall. The momentum has shifted elsewhere. Don't get caught up in the noise. When you clean up the numbers, the real winners in this tech rotation become incredibly obvious. Wall Street will try to scare you into cash, but history shows that staying invested and rotating into the right sectors is the only way to build long-term wealth. The exposure index is at extremes. This is exactly when you should be looking for those under-the-radar names that the herd is ignoring. The momentum is there if you know where to look. We are in a screaming bull market for infrastructure, energy, and smart AI implementation. So to recap, we're betting on Baker Hughes for equipment, EQT for the fuel, and Bloom Energy for the data center power. Those are your 3 pillars. And remember to avoid the crowded trades like Netflix, where the story has already played out. The rotation is your friend if you move early. Credit conditions remain resilient. As long as the bedrock of the economy is stable, this rotation is just the next leg of a massive growth cycle. The big tech sell-off isn't a disaster, it's an opportunity. Rebalance, stay disciplined, and focus on the fundamentals. I'll see you in the next update. Thanks for watching. Don't forget to like and subscribe for more uniform accounting deep dives. Happy investing.